Okay, come to paragraph number 28 again. Before example 3 starts, there is a line. The standard does not permit recognition of DTL on goodwill because goodwill is measured as a residual. Recognition of DTL would only lead to increase in the carrying amount of goodwill because goodwill should not be increased merely on account of a contra item of DTL. So DTL will give rise to more goodwill. More goodwill will give rise to more DTL. And then you will move into an endless loop only. What is endless loop? That means it will not come to an end only. Continuously you will increase DTL, it will increase goodwill, you will increase DTL, it will increase goodwill. See, one example has been demonstrated to prove my point. It says an entity acquires a subsidiary, pays 1 lakh, fair value of net asset 65,000. So normally what entry we will pass? Goodwill account debit 35,000, net asset account debit 65,000 to consideration 1 lakh. Assume tax base of goodwill is nil. Okay, because goodwill is not allowed as an expense. Hence the taxable temporary difference is rupees 35,000. Then assume tax rate is 30%. DTL of 10,500 needs to be created. Now what entry will you pass? If you have to create DTL of 10,500, my entry will become now goodwill account debit 45,500 because goodwill is the residual. Net asset debit 65,000 to consideration 1 lakh and to deferred tax liability is 10,500. Okay. Now if my goodwill becomes 45,500, which means my DTL of 10,500 is not correct. So I need to recognize a DTL of 13,650 now. Again there is a problem. If I change the DTL again, what will happen? Goodwill will again change. So the DTL in entry 2 should be increased by rupees 3150, which in turn will increase goodwill by a similar amount, with consequent impact on taxable temporary difference and deferred tax liability. Therefore, no DTL is recognized in case of taxable temporary difference underline arising on initial recognition of goodwill in the business combination in tax jurisdiction where such goodwill is not tax deductible. Is it right? Now some basic question we will solve. Dear student, come to question number 37. Self practice. Question 37. X Limited acquired the business of Y Limited at a purchase consideration of rupees 10 lakh. Following net assets were taken over. Fair value, tax base. And to save our time in the question only, we have kept 2 columns blank. Taxable temporary difference, DTL. Tax rate is 30%. Pass journal entries for business combination. So this question is a mix of 2 chapters, business combination and IAS 12. So solve yourself. First you compute the temporary difference, check whether it is DTA or DTL, and then pass the entry accordingly. So let me see who gets it right. Is it over? Okay. Check the answer. First you check the TTD 110.3.30, total DTL 0.60. Now check the journal entry, goodwill account debit balancing figure. How much goodwill you have got? 2.60 balancing figure. Machinery account debit 5, equipment account debit 6, to liabilities 3, to DTL 0.6 and to consideration 10. Got it right? Very good. Now write down note. Under IAS 12, there is an exception. DTL is not created on goodwill. DTL is not created on goodwill. DTL is not created on goodwill. Try one more. Problem same as above. Question 38. Problem same as above, except that purchase consideration is rupees 7 lakh. Except that purchase consideration is rupees 7 lakh. So now you will pass the entry like this. Machinery account debit 5, equipment account debit 6, fair value, to liabilities 3, to DTL 0.6, to consideration 7. But this time the balancing figure is on the credit side. Just check. Is the balancing figure on the credit side? So that we will write to gain on bargain purchase 0.40. To gain on bargain purchase 0.40. Say, is it right? Okay. Write a note. DTA or DTL is not created. DTA or DTL is not created on gain on bargain purchase. On gain on bargain purchase, as it is neither asset nor liability. Gain on bargain purchase means it will go to P&L account. So DTA or DTL is not created on gain on bargain purchase because it is neither asset nor a liability. That was the objective of this question. Next question number 39. X Limited acquired the business of Y Limited at a purchase consideration of rupees 10 lakh. Falling net assets were taken over. Fair value tax base, deductible temporary difference, DTA, tax rate 30%, past journal entries. Similar to question 37, but this time tax base is high. Solve. What is the deductible temporary difference in the first case? 1, 0, DTA 0.3, 0. So total DTA this time is 0.60. Journal entries. Goodwill account debit balancing figure. Machinery account debit fair value 5, equipment account debit fair value 6, DTA debit 0.60, to liabilities 3, to consideration 10. Anybody for goodwill balancing figure? 1.4. If nothing is given, on your own do not do any DTA detail calculation for goodwill. Okay. So write a note only. Under IAS 12 there is an exception. Goodwill is DTL is not created on goodwill. DTL is not created on goodwill. Next is one more example, 40. A Limited acquired B Limited. The following assets and liabilities are acquired in a business combination. Fair value, carrying amount, and this time they are so kind, they have written temporary difference themselves only. Plant and machinery, inventory, debtor, total 9% debenture, then net asset, then consideration paid. If I take fair value, goodwill is 30. If I take carrying amount, goodwill is 5. Total of the temporary difference is minus 25. Minus 25. Will it give rise to DTA or DTL? DTA, because the carrying amount is, this will be the tax base now, correct? Even though it is written fair value, this will be recorded in the books as carrying amount, and this will become the tax base. Carrying amount in the books of acquiree is the tax base. So no confusion. This item will be recorded in the books. It will give rise to DTA also. Past journal entry, tax rate is 30%. What? For debtors? Some debtors are not realizable, na? So reduce it. So now write down, first compute the DTA. What is DTA in this example? Directly write DTA equal to 30% of 25. Is the answer printed? First just do the calculation I have done for you. DTA will be 7,500 or 7.50 lakh. Now journal entry check. In your book check the journal entry. Plant and equipment account debit 250. Take the fair value. Take the fair value. Fair value will become now the carrying amount in the books of acquirer. Inventory account debit, take fair value 120. Debtor account, take fair value 200. DTA account debit 7.50. And write the credit items there. Goodwill account debit balancing figure 22.5. Then write down to 9% debenture 100. To 9% debenture 100. To bank account 500. To bank account 500. Note, under IAS 12, there is an exception. DTL is not created for goodwill. DTL is not created on goodwill. Okay, one more question. Question number 41. X Limited acquired the business of Y Limited at a total purchase consideration of rupees 135 million for a net asset value measured at rupees 115 million, right? Which is appearing in this table also. Net asset fair value. This figure. And this is the consideration paid in this table. Accordingly, there is a goodwill of 20 million but that is before considering the deferred tax accounting. However, deferred tax liability arising out of taxable temporary difference on machinery is rupees 9 million, and deferred tax asset amounting to 4.5 million arises out of deductible temporary difference of equipment and trade receivable. You see on the screen, machinery 100 is fair value, tax base is 80. So 30 is the difference, and if I multiply 30 into 30%, this will give rise to 9. Then if I look at equipment, 20 minus 25, 5 is the difference, into 30% will give me 1.5. Inventory, no problem. Trade receivable, again tax base is more, fair value is less. 10 into 30%, 3. 9 is DTL, 1.5 and 3 is DTA. 9, 4.5. Right. Assume tax rate is 30% for measuring the deferred tax. Now they have given so much detail. Carrying amount in the books of acquiry. Is it relevant in our answer now? Not relevant. We are not going to record those numbers. Even the DTL which is appearing there is not relevant. Remove everything. You only record what you want. So fair value you will record. Tax base you will use for deferred tax calculation. Difference they have already bifurcated between TTD, DTD. In the exam, these two columns may not be given to you. Every time they are not so kind. They are usually not kind. Okay. This is only to attract the student that yes, problem is easy. Initial recognition of DTA and DTL by adjusting goodwill. So we'll adjust goodwill, balancing figure. And this problem has one more line. Assuming that amortization of goodwill over 5 years on straight line basis is allowed as per tax law. So in this problem, we will assume tax base of goodwill is also same as carrying amount in the beginning. Goodwill will be written off in 5 installment for tax purpose. For accounting purpose, goodwill is not amortized. Yes or no? Unless it is impaired. So in this example, we are going to see in the next 5 years, the amortization of goodwill will give rise to deferred tax implication, but not immediately. Why not immediately? Because immediately the carrying amount and tax base of goodwill will be same. So first we will see calculation of goodwill. See the journal entry, check whether it is right or not. Machinery account debit tick mark 110 fair value. Equipment account debit 20. Inventory account debit how much? Wait a minute. Inventory account debit how much? 15. Trade receivable account debit 30. Is it right? And you have to also write DTA 4.5. Why 4.5? Based on the DTA calculated on inventory and trade receivable. To payable account 60. To DTL 30 into 30% on machinery, and to purchase consideration 135. So balancing figure is goodwill 24.5. In this question there is a specific adjustment. This goodwill will be written off in 5 installment for income tax purpose. Okay. First you write a note there below this journal entry note. Under IAS 12 there is an exception. DTL is not created on goodwill. DTL is not created on goodwill. Now we'll just understand the next table. There are two tables. Second table you delete because that is just given based on a hypothetical assumption. If the goodwill was 22.5 million and amortized cost life was 10 years. But that is not relevant for this answer. For this answer, the first table is relevant, which I am going to read from your book only. Year, carrying amount of goodwill, then amortization as per tax law, tax base, taxable temporary difference, DTL for SOFP, and deferred tax expense for profit and loss. Okay, so year 0, 1, 2, 3, 4, 5. In year 0, carrying amount and tax base will be same. Carrying amount we are not changing. Sir, why? Because goodwill is not amortized. Goodwill is only tested for impairment. Question is silent about impairment of goodwill. So in future, whenever the impairment will take place, the carrying amount will change. And then the difference will reverse. But this you are amortizing over 5 years. So 24.5 divided by 5, 4.9. And as you will amortize it, the tax base will keep on reducing. And finally after 5 years it is 0. Now if you compare these two numbers, tax base is lower than carrying amount. Tax base is lower than carrying amount, so it will give rise to taxable temporary difference. It is an asset item. So the taxable temporary difference will arise as follows. And this is the difference. On that you multiply tax rate. What was tax rate in this question? 30%? Just check, is it 30%? So your tax DTL for SOFP purpose will be 30% of DTD. So this is the amount that will appear in SOFP. And how much amount you are going to charge in the profit and loss? Just tell me. Is it 1.47? Is it again 1.47? Then this is how much is this difference? Check it again, I have a doubt. Is it 2.94? These two difference? No. It should be 1.47 in all the 5 years. So last column I think is wrong. If your book contains some different number, dear student, kindly rectify. Okay. This answer is over. Come to next paragraph. Pre-acquisition DT of the acquirer. Who is an acquirer? One who acquires the other company called acquiree. A prospective acquirer may have deductible temporary difference in respect of which a DTA may or may not have been recognized. Is the statement right? May or may not have been recognized. Why they have written may not have been recognized? To recognize DTA, there must be either taxable temporary difference, sufficient future taxable income, or certain event which will not normally reoccur again, or there must be tax planning opportunity. If none of these are there, you will not create DTA. Okay, now you are acquiring a business benefit. You may generate profit from that business. Okay, so therefore we have discussed this paragraph somewhere before also, that at the time of some major event like business combination, you will reassess unrecognized DTA, and it is possible that the previously unrecognized DTA may have to be recognized now. Reverse is also possible. You may have recognized some DTA, and after this acquisition, your future taxable income may go down. So you may have to decrease or remove the DTA also. In as much as such an arrangement may either increase or at times even decrease the level of future taxable income. Consequently, it is expected of the acquirer to undertake a review of the status of recognition of DTA soon after business combination. So you have to take a review of your DTA. Now see, there are 2 points. Where a DTA stands already recognized, and if on account of lack of income generating capacity of the acquiree, suppose you have a DTA but now you think you will not have sufficient taxable income in future, the acquirer may need to de-recognize and reverse the DTA. And reverse possibility, where a DTA has not been recognized, and if the business combination strengthens the possibility of generation of future taxable income. Okay, so you have acquired a company which is profit making now, and you think with merger, with business combination, you will have huge profit, may not be huge, you will have future taxable income. Huge is just an example. In that case, carrying amount, in that case, I have written a small wrong note here. In that case, the acquirer can consider recognizing the item at that stage. So DTA can be recognized. There can be situations also where the acquiree does have tax loss carried forward. So whether you will recognize DTA for this, again you have to apply this test. In some tax laws, some tax jurisdiction, acquirer can set off the tax loss carried forward by the acquiree. Then also you can create a DTA, but then you should have sufficient taxable income in future. Next paragraph. The deferred tax benefit acquired in a business combination can be recognized either during the measurement period, that is 1 year fair valuation period, or later, giving rise to 2 different situations. Now, first of all, some students will ask, what is measurement period? So let us go back to IFRS 3, business combination. In IFRS 3, from date of acquisition, you are allowed 1 year period, that is called measurement period. In case if you want to change the fair value of asset, liability, consideration recognized on the date of acquisition, by gaining more information about the condition which already existed on the date of acquisition, not a subsequent event or condition. Event or condition must be there on the date of acquisition. Only we got more information So what I can do, I can go back and adjust the carrying amount of those assets and liabilities, and correspondingly we can adjust the goodwill also. So if the deferred tax benefits are recognized within the measurement period, then it would affect the goodwill if any recognized. So any adjustment if you do will affect goodwill or gain on bargain purchase if the adjustment is made during measurement period, including adjustment relating to deferred tax. In case where the goodwill is less than the amount of deferred tax, suppose I have to recognize deferred tax but goodwill figure is less, then it will be recognized in profit or loss. If the acquired tax benefits are recognized after measurement period is over, now if you have to recognize DTA, after the measurement period is over, the recognition will be made only through profit and loss account. Okay. Now next is current tax and deferred tax arising from share-based payment transaction. Current tax and deferred tax arising from SBPT. What is the journal entry for SBPT? We are dealing with share-based payment transaction, not cash-based. Okay, that is those which will result into settlement through equity instrument. In case of transaction relating to remuneration paid in shares, underline, not in cash. Right, not in cash. You have learnt in one chapter called IFRS 2, share-based payment. There are some share-based payment which are settled in the form of shares, and there are some share-based payment which are settled in the form of cash. So once again you are requested, first read IFRS 2, then come to the standard to understand this paragraph. Otherwise you will not be able to fully appreciate this paragraph. So entry in case of share-based payment plan which are settled in share: employee compensation expense account debit, employee benefit expense account debit to share-based payment reserve, to share-based payment reserve. In case of cash, employee compensation expense account debit to share-based payment liability, to share-based payment liability. Is it understandable? What is reserve? Is it an asset or a liability? Is it an asset, liability, or equity? It is neither asset nor liability. So, carrying amount of SBP is always zero because it is neither asset nor liability. Carrying amount will be taken as zero. It is neither asset nor liability. Is it right? Then whether it will have a tax base, that depends on, that depends on tax deduction. That depends on tax deduction. In case of transaction relating to remuneration paid in share, share option or other equity instrument, the timing of permitted deduction of the recognized expenses by the tax law of the concerned jurisdiction will be the factor that determines whether or not the deferred tax will arise. Now one more issue is here, whether tax laws permit deduction of this share-based payment expense. What is your view? Whether tax laws permit deduction of share-based payment expense? Yes or no? Does this expense is allowed as a deduction by the tax law? Yes or no? Don't know. The third option, don't know. Okay. Recently I asked one person who is good in taxation, and then he has given me this reply. Madras High Court, in PVP Venture and Mumbai IT80 Special Bench in Biocon Limited, there is a case study of Biocon. Okay. It was held that it is allowed as deduction. But there is another case. Bangalore IT80 in VIP industry case. VIP. This Biocon case allowed as deduction. But in this VIP industries case, it was disallowed. Then in Mahindra and Mahindra, it was disallowed. But all these are IT80 decisions, not Supreme Court decisions. And you can see there are different versions. Even the tax practitioners are divided on this issue. Okay. Some tax practitioners are saying yes, some are saying no. What will you do? Whatever is given in the question. If the question says that this expense is tax deductible, welcome, this chapter is applicable. But if the tax laws also do not allow deduction, carrying amount is already zero. Carrying amount is already zero. You have written carrying amount is always zero because it is neither asset nor liability. Tax base may be positive if it is an allowed deduction. Okay. So that is why there is a second line example. It is possible that tax authorities may allow deduction of recognized expenses only when the employees exercise the share option, which results in recognition of deferred tax asset until the period in which the employees will exercise the option or shares are issued. Is it allowed? If yes, when it is allowed as deduction? It will be allowed as deduction when the employee will exercise the option. Okay, so therefore we have to create DTA. We have to create DTA because it will have some positive tax base. It will be allowed as a deduction until the period in which the employees will exercise the option or shares are issued. It is also possible, now see this one more complication. First of all, the student will have to check whether it is allowed as a deduction or not. And second, how much amount will be allowed as deduction? How much amount will be allowed as deduction? Now here again there are three possibilities. Deduction allowed under tax law may be equal to your expense charged in P&L account. Maybe first I'll write less than expense charge in P&L account, and maybe more than expense charge in profit and loss account. Okay. So if it is equal to or less than, then I will pass an entry through P&L account. I'll pass an entry through P&L account, DTA account debit to P&L account. But if it is more than allowed, more than possible, okay, we don't know. Suppose your expenditure charge is 10 lakh, but tax laws allows 12 lakh. So on that 2 lakh rupees extra, we will recognize in equity. Extra, over and above what you have charged in P&L account. If you are allowed deduction over and above that, the DTA will be recognized in equity. Now let us quickly read this, you'll understand. It is possible in such circumstance, in such transaction, for the amount of tax deduction to differ from the amount of related remuneration expense. Like this last example, remuneration expense 10 lakh, okay, in the books, and deduction allowed for income tax purpose 12 lakh. If the amount of tax deduction exceeds the related cumulative remuneration expense, this indicates that tax deduction relates not only to remuneration expense but also to equity. So this tax deduction to some portion is related to equity. Equity is directly recognized in equity section. So you can understand when we discussed in the beginning, where will you charge DT or DTL? Since some portion relates to equity, that portion of DTA will also be recognized in equity. So in this case, the excess of associated current tax or deferred tax should be directly recognized in equity. So what we will do, up to the remuneration charge in books, we will recognize in penal account. If deduction allowed is more than that, that excess will be recognized in equity. One example I will ask you to write. For understanding one concept on ESOP, this simple example is useful. All these adjustments can be a part of a very big problem, okay? XYZ Limited proposes to issue 1000 shares to its 200 employees. 1000 shares to its 200 employees under ESOP. Vesting condition, continuous employment for 3 years. Vesting condition, continuous employment for 3 years. Continuous employment for 3 years. 10% labor turnover. Write down 10% labor turnover per annum. Every year 10% employees would leave. 10% labor turnover is observed. 10% labor turnover per annum is observed. And the fair value of the option is rupees 40. And the fair value of the option is rupees 40. Calculate DTA. Calculate DTA. Calculate DTA. Write down if the entity gets a deduction of rupees 19 lakh. Calculate DTA if the entity gets a deduction of rupees 19 lakh as per tax law. The share-based payment is measured differently. In bracket, as per tax law, the share-based payment is measured differently. Instead of 17,49,600, instead of 17,49,300, then you write down tax rate is it tax rate given somewhere? Not given. So tax rate you write down is 30%. Now you Write down case 1. Case 1, ESOP expenses not allowed. Just write down for understanding. Suppose ESOP expenses are not allowed. Although that is, I think, not a part of the question, but assume tax expenses are not allowed under the ESOP heading. Carrying amount will be 0. Tax base will be 0. Hence, no tax consequence. Forget. You have not asked how this number 1749,600 has come. So we will discuss that, okay? Because that is based on some calculation. Now write down case 2. ESOP expenses are allowed. ESOP expenses are allowed. Carrying amount is equal to 0. Deferred tax asset per annum. How much they have allowed for income tax purpose? 19 lakh. Divide by 3. 633, 333. Now next line item, value of award. Value of award will be 1000 is your, how much? Number of employees? Option. And 200 is employee. And 40 is fair value. And turnover rate is 10% per annum. 3 years are involved. So into 0.9 into 0.9 into 0.9 is equal to 58,32,000. For accounting purpose, we will calculate what will be my total expense, cumulative expense. And in this problem, as the number of employees are not changing, nothing is changing, my annual amortization will be 19,44,000. 19,44,000. If you take this number 58,32,000, just take on your calculator and multiply by 30%. Multiply by 30%. So that should be equal to, I think, this number 1749,600. So as per the tax law, 19 lakh, but as per accounting, it was something like 17 lakh some amount. So which means the tax law is allowing more. Tax law is allowing more than book. So therefore some portion will be transferred to equity. So first you write journal entry, employee benefit expense account debit. This is your expense, 19,44,000 to share-based payment reserve. To share-based payment reserve, 19,44,000. Then out of this 19,44,000, now we have to identify how much should be transferred to P&L account and how much should be transferred to retained earning. Now in P&L account we have charge 19,44,000. So 19,44,000 into 30% if I do, that portion should be recognized in P&L account. Just check 583,200. But tax laws allow you more. So tax laws allow you 633,333. as per this calculation. Okay, so therefore the excess amount, which means some portion of this amount allowed relates to equity. Some portion of the amount allowed relates to equity, so that will be directly adjusted in equity account. Let us call it retained earning. So this DTA will appear in P&L account 583,200 and DTA will adjust in retained earning in SOCIE 50133. Okay, now come to presentation. How will you present the current tax in the SOFP? In SOFP, we have current tax liability, that is the amount payable to the government, and during the year we have paid advance tax and TDS. Can I show net amount? If the following two conditions are satisfied, then instead of writing this on the liability side, this on the asset side, we can show the net amount, but two conditions needs to be satisfied. So it's written in your book also, compliance of the two condition A and B below. If an entity were to offset current tax asset against current tax liabilities. A, first, existence of a legally enforceable right. Existence of a legally enforceable right to offset current tax asset against current tax liabilities. If you have suppose paid advance tax under the Income Tax Act 1961 for the income earned in that year for which you have created a liability, will the law allow you to set off this advance tax against that year's liability? The answer is yes, if it relates to same tax law. But if it is suppose advance tax paid in USA and tax liability is under Indian taxation law, then it is not legally enforceable, right? That advance tax paid in USA cannot be adjusted against tax liability payable in India. Then show it separately. Okay. And one more thing, you tell me, I need to check. Suppose you have paid advance tax for financial year 2020-21. Okay. And current liability is for 2021-22. Can this advance tax paid be set off against this liability? No. You will get refund from the government separately. So then in that case you can't set off. Is it right? Next is if and only if the entity intends to, if and only if the entity and, there is an and also written here, if and only if the entity intends either to settle on a net basis or to realize the asset and settle the liability simultaneously. Not only you must have a legally enforceable right, but you must also intend to settle on net basis. So normally in India, people intends to settle on net basis only. At the end of the year, what I do? Once year is over, I calculate my tax liability. I see how much advance tax and TDS I have paid, and then I will file a self-assessment tax, which is the net amount that I have to pay, or I will claim a refund. So in that case, I can show the net amount. What about the deferred tax asset and liability? Now, deferred tax asset is also there. Deferred tax liability is also there. The problem becomes more complicated if you are preparing a group accounting. That is consolidation. So normally in consolidation, this will not be set off, because tax laws do not tax a group. Tax laws will tax individual entities. So you will not have a legally enforceable right to set off. Advance tax paid by subsidiary cannot be adjusted against the tax payable by the parent company. But still they have written in the note that you may set off if certain conditions are satisfied. A similar requirement as to existence of legally enforceable right has been prescribed for offsetting deferred tax asset and deferred tax liability. So you can set off DT and DTL also if there is a legally enforceable right. The other condition is that the entity should ensure that DTA and DTL relate to income tax levied by the same taxation authority. Up to this only first we'll understand. DTA and DTL should relate to income tax levied by same taxation authority. If you are a global company, multinational company, DTA may relate to US income, okay, and DTL may relate to Indian income. Will you set off? You will not, because these are not levied by the same taxation authority on either the same taxable entity. Up to this is for single entity, or in case if you are preparing CFS, DT and DTL should be levied by same taxation authority on different taxable entities which intends either to settle current tax liability and asset on net basis. Which intends to settle current tax asset and liability on net basis. Now, is it possible if there are different taxable entities, can we set on net basis in a group accounting? How it depends. Law will not accept one entity's advance tax and one entity tax payable. If the tax authorities review, okay. Not in India, somewhere else, okay. Then you can net off. Or means this is either or condition, or they intend to realize the asset and settle the liability simultaneously in each future period in which significant amount of DTA or DTL are expected to be settled or recovered. So if you can follow this condition, you can set off in the SOFP. Now we will continue tomorrow.